Hey, what's going on, cash flow hackers? It's Chris with Life 180. Today, I am going live talking about this whole video that Caleb did with Roccy DeFrancesco, talking about IUL versus whole life. It's gotten some play, it's gotten some traction. Roccy is somebody that I've known about for a long time. He's somebody that was around when I was back in my day, when I was actually in the IUL space. This is one of those things where Caleb did this interview, full transparency, just so everybody knows. I spoke with Caleb about this. I spoke with Caleb about the fact that I'm going live, and the fact that I'm going to react to this. He's out doing a different event right now, but I needed to come on here because one of the things that I love Caleb like a brother, and I feel like sometimes he's just a little too soft. Now, some might argue that I'm a little too hard, and we can have that conversation. I totally get it. I think very bold in my statements and opinions, but one of the things that I think a lot of people don't realize about me is that I spend probably more time trying to prove myself wrong than right. And so that said, when I come to a conclusion, I'm pretty opinionated in that conclusion. And so I'm really excited about this because we're going to go through this video. I've had a bunch of people send me this video. I've had people make these asinine comments about the fact that they're like, you should interview Caleb because Caleb has shifted from whole life to IUL. And I brought that to his attention, and he was like, no way, man. Like there's zero chance that's happened. I don't know how people would watch my content and believe that would be a possibility even. And yet here we are, people do that. And so I'm going to go into this video. I'm going to share my screen. Actually, let me get this set up here. Share the audio. We are going to get into this. So you could see here that I'm sharing the audio. I'm sharing the screen. I'm sharing the video. And this is basically what I'm going to do is I'm going to increase this so we got the whole screen there. And we're going to watch this. Now, full transparency, I'm putting this on 1.25x speed simply because I usually watch videos at 2x speed. Watching them at below 1.5x even drives me crazy. It just doesn't move fast enough. I am doing this in another tab, so I can't see all comments from everybody that's involved. But I will say I'm going to check back and forth for comments as often as possible. So I really, really encourage you, comment, ask questions as I go through and watch this. Ultimately what happened was Caleb, I think, was just a bit too soft on Roccy. There were a lot of opportunities that Caleb went a little too easy on him on when Roccy said things that to me just weren't true, that were just, honestly, hand is pink waving. I don't know. That might be a buffering issue for me. So I'll stop moving my hands. But the bottom line is, I think, I don't know if it was because Caleb wasn't comfortable getting into the technicals of the product with Roccy, because Roccy, I think, can be kind of intimidating to some people when it comes to product knowledge and how he kind of tries to push his perspective. And so I'm not going to go easy on this. I'm gonna bring it hard, and I'm going to say right out of the gate that I challenge Roccy to a live conversation, a live debate about this, because there's nothing in this for him that I think would go well. I think he wants to avoid people like me. He likes to talk to people and get on his soapbox and have his talking points against people that aren't able to fight back. But to me, that's just what bullies do. So without further ado, let's do this. I'm going to get into the video here, and let's start watching, and I will go from there.
I convert maybe one advisor every 5 years from whole life to IUL. It's like a freaking cult. There's no mathematician who's going to come up with a way to get whole life to get a better rate of return on cash over time. It's almost impossible mathematically.
Why do you think the whole lifers hate IUL?
I'm going to get into all this after, by the way. This is just his hook, so I'm going into this. He's got a 50-minute video here. My guess is this is going to be about, I'm hoping to shrink the time frame of this video by doing the 1.5 or 1.25x. Obviously, cut 10 minutes or so off the video as far as the watch time goes, but I'm going to get through this and I'll address all of the hook elements that he puts here when they actually happen in the video.
IUL.
If you can mathematically show me why whole life is better, I will start singing the praises of whole life.
Do you agree that there are some IUL companies that are playing games?
I'd say most of them do.
Another talking point that I hear is if IUL is not set up properly, not funded properly, that it could blow up in the future.
That's such a fear-mongering bunch of nonsense. Almost no liability with these products. That's the beauty of it. There's very little downside for the insurance company. There's no risk. The risk
Other than
is
the quarter of insurance, which is very low.
yeah, that's not a risk because they're charging for it.
How many percentage of advisors are actually doing it right? But is it less than 10%?
Wow.
5%?
Well,
It's a great hook. It's a great hook, Caleb. I love it. His video editors are awesome.
All right, everybody. The conversation that you've been waiting for. Roccy DeFrancesco, good friend. He's a recovering attorney. He's writing his 13th book. He's a big proponent of Index Universal Life. He has a whole company that helps advisors as it relates to all things helping clients. And Index Universal Life is one of the products that you are an expert around and that you teach. And then you also work with people around the country as well directly. So Roccy, welcome to the show. We're going to be talking about Index Universal Life versus whole life and just why you believe IUL is a superior product. Before we dive into that, why don't you give just a little bit of your backstory, and then if you could tie into what like your epiphany around life insurance in general.
for those who care, I'm an attorney, a recovering attorney, and I came into the industry being financial services, insurance. I really came into it backwards. We don't have time for that part of the story, but way back in the day, I ended up having to research advanced planning topics for some wealthy clients, and I came to the conclusion that I'm talking in the late 90s, a lot of advanced planning concepts use cash value life, right? So as an attorney,
That's true.
we like to do, well, most of us like to do research, right? And like the more research you do, the more prepared you are, the better chance you have of winning. And so when I got into the life insurance industry, what I did was I researched product like I was going to court, and I had to brief it for a judge, and I had to put forth my reasons as to why I like this.
I think what he's going to do here is he's going to go like, after researching the product, what I've come to is that IUL is this great product. I would love to see him as an attorney defend the results of IUL compared to how they were sold and how they've actually performed since they were incepted in 1997. That would be a laughable thing to me.
This, right, like that. So there's not a lot of people in the industry that spend that kind of time doing the research on these products. So I kind of got to the point where, I was on a first name basis with the actuaries at the companies because I really want to understand the pros and cons and how they worked and that sort of thing. So over the years, as I got out of the industry, I used to be in law and fell in backwards into the industry I'm in now, which is to educate and mentor advisors and to help them with their clients. I've written books, literally books on cash value life, and I try to give the pros and cons. So, I know the setup with this, and those people that are watching that do know me, it's not that I'm a hater of whole life. When you're in law school and you do your products liability cases, nobody cares what the company makes. What they care is what were the injuries. And so everything in law school is a widget in our examples. I try to bring that attitude toward the financial services and insurance industry, which is try to treat everything as a widget. A stock is a widget, a bond, a structured note, cash value life, an annuity, and then different types of cash value life are all widgets, whole life, universal, variable. And let's treat them as widgets. Let's look at them independently. Let's find the pros and cons. And then let's just do what we should be doing, which is apply the best product for our client to get them the best outcome to accomplish their goals.
1,000%.
My opinion just happens to be I don't have a lot of use for whole life in the life insurance realm. And I think that's what we're here to discuss.
Yes, it is.
I really appreciate that backstory, and I 100% agree with you that we have to look at financial products as tools, and we need to be outcome driven. What are the outcomes that you want? And then reverse engineer, not get emotional about insurance or annuities. That's one of the problems with some of the gurus out there is they are so tainted, and so it sometimes they can't put their bias aside to actually lean in and say, what do you really want, and what product can help you accomplish that? Roccy, I'll let you set up like you're an attorney or pitching something to a court or a jury, and why IUL, and we can do this the way that you want to do it from a standpoint of what.
I don't think we start with the question of why IUL. I think we start with the question as to why cash value life, right?
Okay.
So, and that really becomes a huge part of the debate that I think gets lost. Like, why are we buying the policy? Now, when I typically recommend cash value life, the reason we do it for the consumers is we like it because it can be a conservative asset class. It's an asset class where money can grow tax-free and come out tax-free. So we've recently done an IRMA penalty video, and one of the tools to help avoid an IRMA penalty.
Problem here, by the way, is I agree in the notion that getting cash value life insurance is huge, right? Like it's the benefits of it are massive and are oftentimes overlooked and misunderstood by people. But to say that you can do this risk-free with IUL is just malarkey, quite frankly.
Is cash value life. And again, in the industry, which is why I wrote my book, Bad Advisors, insurance agents like to sell life insurance, right? Financial planners like to pick up assets under management. To me, again, because everything's a widget, we're trying to spread our money around. So when you're using cash value life, it's just one of your asset classes, not all of your money had to go in here because this is the best place it should be. It's your typical life insurance salesman. All of your extra money needs to go in cash value life because it's the greatest thing since sliced bread.
Mm-hmm.
Maybe.
By the way, that's what people like Doug Andrew does. Like Doug is a huge proponent of take everything you have and put it in an IUL. So to be fair to Rocky here, I'm not sure what his perspective is on what percentage of your net worth or free and clear cash flow or retirement plan you should be putting into an IUL versus other assets. I'm not sure kind of where he stands on that position to like a high level of detail. But I will say that people like Doug Andrew are all about just being all in on IUL. And so it's good that he at least agrees that that's a problem.
That's a 20, 30 year answer to a question. It's better to spread your money around. So why do we buy it is a huge question. So let's get off the table that we're not buying it for death benefit. Now, if you're buying life insurance for death benefit, that's a different discussion, which is whole life versus guaranteed UL or assumption IUL. It's a totally different discussion than what we're going to have today. Today's discussion is using cash value life as an asset class, but for what purpose? Now, generally, when I'm recommending cash value life, it's because I want to grow money tax-free. I want to grow money risk-free, and then I want access to it.
So right there, you cannot say that you are growing money risk-free. That's basically saying that you're guaranteeing, because risk-free would come with guarantees. And if you look at the guarantees inside of IUL, it's just mathematically that's not accurate. And I think compliantly what he's doing is he's getting around the using the word guaranteed, because you can't use the word guarantees in IUL, because when you look at the guaranteed column, they suck. And so he's just saying risk-free instead of guarantees. And because you can't use the guaranteed word, the G word, with any other products aside from annuities when you're using the guaranteed income riders, or with whole life from a permanent cash value policy perspective. So let's see where it keeps going.
But at some point, tax-free. Okay. When do we typically want to do this? When we're building them and we're designing them, we're typically doing it so that we can plan to take it out in retirement. Because we're going to let all this money grow tax-free for all of these years. The longer we can let it grow tax-free, the better off we're going to be. And then we're going to be able to access it tax-free in retirement. So if we're doing it for a 25-year-old or a 35-year-old or a 45-year-old, even a 55-year-old, usually we're not showing cash flow from it until 65, 62. Now, one of the cool things about cash value life that the advisors know and the consumers should know or need to know is there's no 59.5 rule. You take money out of it at any time, so long as that you can sustain it, taking out the money. So you can take it out at 50, you can take it out at 40, you can take it out whenever you'd like, through a loan. And I don't know that we're going to get into loans too much, although the loans in an IUL policy are much more flexible than the loans in a whole life policy, which is a whole other issue. So, but I'm going to show borrowing, let's say, from 65 to 85 or 88 or 90 or whatever it is. Now, for the advisors out there and for the consumers, I really despise it when advisors show borrowing until age 120. It makes the IUL look unrealistically good. It makes any cash value life look unrealistically good. You're not going to be alive at 120. And if you're alive at age 100, you're not going to be borrowing $100,000 out of a policy so you can take a vacation to Europe. You're going to be bedridden waiting to pass. So just showing illustrations that borrow out till age 100, 120, I think is ridiculous. We typically stop them at age 90. Would they look better on paper? If you show them till age 100 or more, they would. I just think it's a sales trick.
I don't think they look better on paper. I mean, like, I think anybody with a brain just kind of looks at them, and when you look at the illustrations, for instance, and you look at how the illustrations are run, if you look at the illustrations and you look at how those illustrations are run, now you're looking at the fact that, all right, they have 50 basis points of positive arbitrage. And when you look at it going past age 90, that arbitrage has been built into it. So that income based out of it is just unrealistic either way you look at it. All right, what do we got here? So somebody's making a comment. Let's see here. Respectfully, risk-free isn't the equivalent of guaranteed. Risk-free is a context, meaning you're chasing. Risk-free in this context means you're chasing will not decline. Your chasing will not decline as a result of market loss. Your account can go down due to market loss if you have policy loans out on the policy. This is the part that everybody misses, Deontay. And I've done so many videos on this. Your cash value can still decline as a result of policy charges in years when there's no interest earned. Yeah, you're right. But to say that there's no risk because of that, no, you may not be losing money because of your investment being lost, because ultimately all you're doing is having a call option, okay? So you may not lose money to that specifically, right? And I'll give you that, right? Like you're not, but what you are losing is the call option, right? So that call option gets lost. There's no credits to the account. And so then therefore you lose. And I don't care. You can say, I don't care why you lose. What I care about is the net result. What is the performance of the account? You can use wordplay and all the bull crap. You say, I'm glaringly like biased, but no, I'm not biased. I'm biased towards actual results, not wordplay, not your bull crap that you're talking about with all this. I'm biased towards actually results, what we can actually measure. And when you look at the fact that when the market goes down, especially in retirement, especially when you have loans against the policy, and those loans are index loans, which means you're trying to take advantage of the potential upside spread. You don't realize, most people don't realize the absolute risk that when you have a, let's say you start taking loans at 62 and at 72, your first 10 years of the loans, you're taking $100,000 a year out of your policy. You've taken $1 million in loans, but you've also got the interest compounding on those loans. And what happens is, go look at the illustrations. It's showing 50 basis points of positive arbitrage. I've done this on so many examples with so many different companies that shows even in positive, with having positive years every single year for the first 20, 30, 40 years of the policy. And then boom, you get to age 70, 75. And when you have all these outstanding loans because of your tax-free retirement that you've been pulling out, if you have a couple down years later in the policy, the opportunity, the chances of that policy imploding due to a couple negative years go through the roof. I understand that the risk isn't that bad right now. That's not what I'm concerned about. What I'm concerned about is when you're 70, when you're 71, 72, 73, 74, what happens then? Now, if you have your policy in that situation and you're 72, 73, 74, and your policy lapses because you had so many outstanding loans, and when you have $1.5 million of outstanding loans because of the $1 million in loans you took out, and then it goes, you have the interest compounding on top of it, you owe, let's say 5% on that. It's $75,000 on $1.5 million, right? If you lose, you have a 0 year, that $75,000 is getting paid from the policy. That is a loss. I don't care how you slice it, that's a loss. As we've discussed before, a whole life policy is far more expensive. No, it's not. It's not more expensive. That's the thing. It's just not. Their insurance is a little more expensive. Sure. You know why? Because it's guaranteed. It's permanent. It's guaranteed. It will be there. You know that. Like 100% beyond the shadow of a doubt. If you can't compare the costs, yes, whole life is a smidge more expensive on the front end. And if you die a little earlier, then it's going to be more expensive. But if you live a long, healthy, happy, fruitful life and you live in your 90s, IUL is going to wind up costing you more. Period. That's just the way it is. So anyway, let's keep going.
Insurance agencies, whether it be whole life or index universal life. Although, getting back to whole life, the next time I see an illustration come across my desk from a whole life agent that shows borrowing from age 65 to 90 in retirement will be the first one in 20 years.
That's because you should never use income from your whole life insurance policy or IUL. If you do IUL, my encouragement to everybody is don't bank on having income every single year out of the policy, period. You just can't do that. The risk, go read the illustration on your IUL policy and read what the insurance companies put in there, what happens to the risk in your policy when you take policy loans out of it, okay? People like Deontay here, people like Rocky, they like to talk from their potential. Like Rocky likes to use the word math. Like mathematically, whole life can never compete to IUL. Well, I want to see if Rocky's so good at this. Rocky's amazing at this, right? I don't care about your math. Life doesn't exist on spreadsheets. I want to see real world life examples of people that have done this successfully, that have funded a policy for 15 years and have successfully executed and have successfully taken income through policy loans for tax-free income in retirement for 10 to 15 years and actually like done it in real life. I don't care about your theory. I don't care about your spreadsheets. I don't care about your math because life doesn't exist on a spreadsheet. There's so many variables outside of the control of you, the policyholder, that the insurance company have the ability to change, that they will change. Look at the cap rates. I created the IUL challenge. If Rocky is so confident, Deontay, if you're so confident that everything is good, that IULs do what they say they're going to do and that they're good, well, I got $10,000 I'm offering to somebody to win the IUL challenge. If they could just show me an IUL in the greatest bull run of all time that performed the way that it was sold, not even performed above how it was sold over the past decade because of the fact that we have, the greatest bull run. So if the product's supposed to give upside potential and downside protection, if you can't take advantage of the upside potential compared to how it was sold during the greatest bull run of all time, what the hell are you doing, right? What are these products ever going to do? And the fact that people try to sidestep this all the time makes my head want to freaking explode, right? Like people like Deontay like to just back up their thing. You use this poor selling practices of insurance. No, I don't use the poor selling. You show me the best IUL design you have, and I'm still going to whoop your butt with facts.
Which blows my mind because that's why I am telling a client to buy the policy, to buy out from 60 to 90 or 60 to 85.
That's insane.
But whole life agents, generally speaking, do not show borrowing from the policy in retirement. And I know why.
Because it's supposed to be a volatility buffer, right? It's not designed to be leaned on every year. Life insurance is an amazing asset when utilized as part of a greater financial plan, period. If you combine it with real estate, other investments, business, pensions, whatever else you have going on. If you use whole life insurance as a bond alternative with a lower standard deviation to be part of your entire portfolio as a volatility buffer, it will make your other assets perform better. But fundamentally, philosophically, utilizing life insurance for income every single year in retirement just doesn't make sense. Mathematically, on an illustration, people like, Rocky here are going to say, well, look at what it looks like. That's not reality. It shows 50 basis points of positive spread between your loan costs and what it's getting credited in the illustration. That's regulation AG 49B at this point in time. That is what allows it to be that. But remember, these companies, what's been happening is, and I talk about this in my new book, IUL Exposed, there's been so much regulation overhaul, and I equate it to the feds chasing Al Capone back in the day. It's like they know that they're guilty. The regulators know that these carriers are guilty, so they keep changing the regulations on how they're allowed to illustrate their products. As soon as the regulations change, the companies find ways around it, and they find new loopholes. They find new ways to position the IUL products so that they can still illustrate at these unrealistic numbers. Eventually, what's going to happen is complete overhaul on illustration regulation completely. That will just completely derail everything. Yeah, Joel. I mean, personally, I'm trying to get Rocky on my channel. Like, I want to debate like big IUL people on our channel. I am down to debate on the BetterWealth channel. Guys, if you guys don't know Joel Robertson, Joel is the guy that runs all the stuff for Caleb on his channel. He's a great guy. Glad you're here, buddy. So yeah, man. I'm looking at this like, oh man, this guy drives me nuts. Let's keep going.
I just disagree with it. So, we get into the infinite banking stuff and the other stuff, but so that's the baseline question. Why do we buy it? And for the discussion for today is to access the cash when needed. And then the question is, when should we? Should we do it to buy a car in year 5? Should we do it to pay off our mortgage on our house? Should we simply let it grow until retirement and then access it that way? So there's different uses of it. Ultimately, the question I'm most interested in is which policy is designed to get me the most cash flow.
Okay.
That's the basic question, right?
Yeah. So just to re-emphasize or say back what you're saying is there's a lot of different philosophies and pitches out there, but for you, you're focused on, we're not having a conversation around death benefit, protection, estate. We're not having a conversation about infinite banking, bank on yourself, early cash value. We're having a conversation about what will optimize when I'm 60, 65, and I have a portfolio, what's going to maximize my cash flow and do it in such a way that after you pay taxes is better off than any other asset class. And so that's just like setting the stage. And your theory, your belief, your bet is that IUL, when set up and used properly, is the best asset class versus whole life. Well, I'm not saying that, you're saying that that's better than any other asset class, although there's a good potential reason why, like there's a reason you're a big fan of IUL. But when it comes to whole life, you're saying IUL versus whole life when you hit retirement and you're taking retirement distributions, IUL smokes whole life when it comes to that.
Yeah, it's really not even close. And you can use IUL for infinite banking yourself. And it mathematically, I believe it works out better.
Well, so to that point, he says you can use IUL for infinite banking. I'm going to turn this off and talk for a sec. So he says you can use IUL for infinite banking. You can't use IUL for infinite banking simply because the contract in the IUL, infinite banking requires the guarantees, requires your control and the contractual obligation to be in your favor as the policyholder. That's the thing, is like, yes, life insurance companies make profit on all products that they sell. Otherwise, they wouldn't be in business. And the difference is when you are a policyholder with a participating mutual company, you are participating in that profit. That's how a dividend gets paid. Now, if the company struggles with profit, yeah, your dividend can go down, but at least you have the guarantees on the back end to balance everything out. The challenge with IUL, and like I said, if IUL were so good, it wouldn't have a track record of just worse and worse and worse performance over the 27 years that it's been in existence, right? Like if it had been performing in the way that, that it was sold, then we wouldn't be having this problem. Hell, I wouldn't even be here. I'd be probably making videos advocating for IUL because I got into the IUL industry first. I was an IUL agent, and my job is to recruit and train and develop IUL agents for one of the top companies in the country. That was what I did. I did it for 4.5 years until I realized what I was selling, what I was training was actually not even the truth. These carriers don't even allow you to speak the truth. They force you, even from the top down, to speak have truths to the field because they don't want everybody to understand everything on an in-depth level because, I don't know why. I feel like if agents knew exactly what they were selling, they just wouldn't sell as much, right? I think that's really what it comes down to. So let's see here. What are they saying? They pull from different buckets, some from their defined distribution plan. Okay, I'm not going to go through all that. I'm not going to get into all the details of all the comments that are going on right now. If somebody's got a specific comment, to the video, let me know. We will go from there. I'm going to pull this back up, but at the end of the day, really what it comes down to, I love what Caleb just said and how he positioned it. We can utilize cash value life insurance in a lot of different ways. I look at it as a great asset. It's a great emergency fund alternative. It's a great way to keep safe, liquid, accessible capital for real estate investing. It's a great way to increase financial efficiency and control cost of capital, like in the market environment that we're in right now, where rates have gone really high on real estate investment properties, right? And I can access money cheaper in my whole life insurance policy loan, right? And I know I can do this predictably with less risk, and I know it's going to be there, and I know the variables in the product can't get switched on me. I am not trying to create wealth in my policy. That is the difference fundamentally in the belief, right? I'm not trying to create wealth in the policy. I'm using my policy as a storage vehicle, as a foundational asset to create wealth outside of the policy. That is the biggest difference here, right? So people like Roccy and other IUL agents are going to try to convince you that the life insurance policy is the one-size-fits-all amazing vehicle that's going to get you amazing returns with no risk at market loss, that's going to be an amazing income distribution vehicle, which, by the way, this argument that Roccy is making right now is exactly why Curtis Ray just got a cease and desist and is getting in trouble. It's exactly why, which by the way, I've got a video coming out in a couple days. I interviewed one of the top IUL litigation attorneys, and I'm putting together a series with him because this guy, by the way, this guy is sued and beat Doug Andrew on over 100 policies, right? So if Doug is so good, if Doug is so amazing and so amazing at designing all his policies, I know that's not the point of this video, but if he's so good at all that, how in the world has he been sued and lost in court over 100 times? How? How is that possible? I can't imagine the industry leader who's the best of the best, who quote unquote has all the best designs and does all these things so amazingly and teaches everybody, right? I can't imagine that guy who teaches everybody and is like the god of the IUL industry to all these people. How would it be possible for a guy like that to have over 100 policies out there that he could get sued on and lose? It's one thing, anybody can get sued for anything. Okay. Anyway, let's keep going. Doug is grossly misleading. I agree. Let's play this again. Sorry, I was on the wrong tab. Here we go.
It's just that community is so brainwashed in whole life that it's offensive for them to even consider IUL in that space. But you can do infinite banking and banking yourself with IUL, and I think you'll have a much better outcome. I'm personally not a huge fan of that, but even having said that,
he just thinks IUL or infinite banking is about the positive arbitrage, about the spread between what you access your money for and what you earn on it, and that's not what it's about at all. So he's the one who's wildly misunderstanding what infinite banking is, right? And so then he wants to get critical to them to back up his product that isn't in alignment with infinite banking philosophically, because of the fact that you are not in control as a policyholder. And that is the fundamental reason infinite banking doesn't work with IUL. Not because of the spread and arbitrage, which all these people that sell IUL and think they can do infinite banking with it, that's not what it's about. And I just wish people like Rocky would understand that, but he'll never acknowledge that. It's funny to me that an attorney likes IUL like this, because we're talking contract law. That's what life insurance is. It's contract law. Go read the illustration. With whole life, as long as you meet your obligations as a policyholder and you pay your premiums, the life insurance is obligated to meet the obligations to you. With IUL, the contract is basically the other way around. You are obligated to make your premium payments, and the life insurance company has the opportunity, the rights to change the terms of the contract to their benefit. I won't even say their benefit. That's not fair, because that makes it sound like they're trying to screw you. They're not trying to screw you. To their protection, right? So whole life, the contract is skewed towards your protection as a policyholder. IUL, the contract is skewed towards the protection of the life insurance company. So is whole life insurance going to be a little more expensive? Probably. Think about it. It's a different contract. There's more risk for the insurance company. So, risk is always priced accordingly. These insurance companies aren't stupid. They price things accordingly. Just use your brain. Think critically. And when you really get beyond the illustrations and the moving parts and how these things spreadsheet out on illustrations that aren't even worth toilet paper when they're all done, you realize, that's what it's all about. Contract law.
Look, we are funding a cash value life policy that has cash. And while I would prefer the client to wait until they're 60 or 65, if they get out year 7, year 10, whatever it may be, if they need the cash, it's just an asset.
Right.
Now, I would hope that they would use other assets to cover their needs, but if they need to access it, they can still access it from the IUL, just like they can access it from the whole life. So, it does function in the other space. It's just that the crowd in the infinite banking space despises it, and you never see it.
Right. And we spoke about this before we started recording, but I asked you about early cash value versus not. And there's riders that you can put on IUL that increase early cash value, but you rarely, if never, sell that, because that rider hurts the back end cash flow. And the majority of the conversation is, hey, we're setting this up for retirement income, not for bank on yourself. Two questions. You want to just confirm that? And then the other thing is, why do you hate the concept of becoming your own bank, infinite banking, and using your life insurance while you're young?
Yeah, well, I would confirm the first thing you just reiterated. It's not that I hate bank on yourself or infinite banking. I despise anything that is sold in a non-full disclosure manner.
I do agree with that.
And the next time I run into an infinite banking salesperson that also shows them the same concept with IUL will be the first time ever. And infinite banking is almost
That's
universally
not true.
sold in a vacuum.
That's absolutely not
And when
true.
I say that, I mean,
people are trying to
okay,
say they do
here's infinite banking,
all the
and we're going to
time.
borrow out in year 7 to
With
buy a
IUL.
car, or year 5 to buy a car, or whatever it may be. And then we're going to put money in here, we're going to take it out, we're going to put it in, take it out. And here.
And for the record, just so everybody knows, I'm not like an infinite banking purist. I'm not a massive infinite banking like follower, so to speak. Like I'm not one of the like I'm not an NNI certified person with infinite banking because of the fact that I don't believe in all of it. I believe in most of it, but unfortunately, my experience is if you don't believe all of it and drink all the IBC Kool-Aid, then you're pretty much not really welcome. And so what I do is I just keep my distance. I do my own thing. I believe in a lot of the principles. I believe in using your policy as a foundational asset to leverage against, to protect yourself. I believe in having it there where that asset gives you the foundation and the guarantees and the control and the predictability, all things that you don't have. The control and the predictability are two things that you need to have. One of the reasons IUL doesn't work for infinite banking is because on down years, when you borrow against it, if the market keeps going down when you borrow against it, it's one of the reasons it doesn't work for real estate. On down years, I want to borrow against my whole life policy to put into real estate, right? If I borrow against my whole life insurance policy to put into real estate, well, I know that on a down year, I have predictability on what the costs and the fee structure inside of the whole life policy, what to manage my loans are going to be, and so on and so forth. If I borrow against my IUL and I'm trying to, and because what people are trying to do, and they're going to say, oh, you could do the wash loan. Well, you can, but they're never going to, right? Like it's one of you do that. And if you use a wash loan, there are other consequences that come along, with the long terms of the policy. So if you use the index loan with the IUL for real estate in a down market, and then the market has a bigger down year, all you're doing is injecting more risk into the real estate play. That's what you're doing, because if the market has a down year, which you don't know what's going to happen, and you take 500 grand out for your property, and that's what you want to buy, and then the market goes to zero, and you got a 5% loan expense on that 500 grand. Now you got $25,000 of extra expenses potentially above and beyond everything else that's going into place. So from a cash flow perspective, that may have a negative consequence. That is the reason you cannot use IUL for infinite banking. In a vacuum, on a spreadsheet, I'm not going to dispute that IUL is going to look like it has more potential. It's going to create more wealth inside of the policy. That's what it's designed to do, is to have the potential of it, okay? I'm not going to dispute that. That is the purpose. That is how IUL was designed. That is how it's sold. Life doesn't exist on a spreadsheet. The important parts of infinite banking, even though I don't agree with 100% of it, but the important parts of infinite banking are the control and the predictability to be able to have this asset that we can leverage and create wealth outside of the policy. Anything you're going to do to try to create more wealth inside of the policy, which is what the sale is for IUL, is going to come with more risk. Anybody that says that's not the case is delusional and doesn't understand simple math. They don't understand how risk is priced out with these insurance companies, and they've just not been around the business long enough. And so that's really concerning to me. All right, let's keep going.
Here's your outcome. It looks great. What did we compare it to?
Exactly.
We compared it to doing nothing. We know it looks better than doing nothing. When you're talking about accumulating wealth, doing anything looks better than doing nothing. Putting money in a CD, even though I don't recommend that, is better. Putting money in a savings account looks better. Putting money anywhere looks better than doing nothing.
That's correct.
So putting money in a bank on yourself or infinite banking will always look better than doing nothing. So the question then becomes, well, why didn't you compare it to something? I think that'd be better. The reason you don't is because you don't need to in the sales pitch, because you can make the sale without comparing it to anything. I'll throw this out to any advisor that's watching, including our host. You do your best. You do you with your infinite banking or banking yourself. Just build the fact pattern. Do whatever it is you want. Show your entire cash flow for this client from now until death.
Sure.
Give me the numbers. Give me the illustrations. I will take the client's same exact amount of money available, and I'll design my plan. And then we'll give them to the client. And my plan will have the client significantly more money when they die, when they're in retirement, than yours.
That is all based on the fact that he's going on non-guaranteed current assumption illustrations that are just unrealistic, quite frankly. Like it's just not, it doesn't, I don't care what you're going to show on the illustration. What I care about is what we know is going to be there. We're not speculating. We don't want to speculate with the life insurance once again. Okay. So if he did this 15, 20 years ago for me, and we had this conversation 15, 20 years ago, okay, that's fine. We could have had it. And he's right. He would have been able to illustrate. I probably would have lost a sale to an uneducated client because his illustration would have showed wildly better performance. And guess what? IULs have way underperformed because cap rates have dropped, costs have gone up. Like all these things have changed in IUL space because contractually, the life insurance company has the ability to change things that protect them over you. Whereas whole life insurance, the contractual obligation protects the policyholder. Okay. It's not as sexy. Whole life isn't going to illustrate as good. It's not going to show the upside potential, quote unquote, right? You just get what you get. But it's a predictable, safe, dependable asset. IUL is not. And anybody that says it is hasn't been around long enough. And if you think it is and you've been around long enough, show me one example where your policy has outperformed the way it sold, or at least matched what you said it would sell at. And I know people will tell me that
would be
whole
the
life.
comparison. Hold on.
I know that people will tell me, well, whole life hasn't performed as well either. Well, whole life isn't sold under the guise of upside potential. Okay, IUL is sold with the idea that you can capture upside potential due to the way it participates in the market, like the S&P 500. If it's sold on upside potential, you got to be held to task on actually performing the way it's sold, especially in a bull market where the market is way outperformed long-term averages, right? Like you have that. To me, there needs to be a standard that these products have actually done what they said they would do, based on quote unquote conservative illustrations, because that's the way they're always sold, because otherwise they wouldn't be able to be illustrated like that. So if they're not performing as they were sold for the past 10 to 15 to 20 years, well, then what are people buying? If you can't take advantage of upside potential in the greatest bull run of all time, what's it going to do when the market isn't as good? I stand on the fact that I believe, and I think math shows this, that IULs have been bailed out by the bull market, and they're going to be completely exposed when this bull market comes to an end, which inevitably it will, right? And we go into a longer term, kind of more flat, mediocre cycle in the economy and the performance of the economy, or even maybe potentially a downward cycle. That's where IUL is going to get more exposed. So anyway, let's keep going.
Everybody to do. It's just never done.
Yeah, no, I accept that. And that will be a really great video that I think we could do and break down and hopefully show pros and cons. Because I do agree with a couple things. There should be comparisons for sure. And then the second thing when it comes to infinite banking or bank on yourself is there's a lot of conversations around buying liabilities, going on vacations, maybe paying off your mortgage. And if you've watched any of my videos and see my opinions on that, I think that also can be very misleading. Yeah. And for the same reason that you say is it's in a vacuum, and I call them half truths. Yeah, they're like, guess what? If you can help people save more money, you're bettering their situation. And this, you might not disagree with this, but disagree with this, but I believe if you're helping people with a strategy versus no strategy at all, like there are many people that are actually just saving more money based on a tactic or strategy, and they're by default better off because they're sticking with something versus not. But that doesn't necessarily mean that, again, they're doing the right thing. They're better off. And so I think there is some more complicated things that we could dive into. But I do agree with you, by the way, on everything that you said. And I just think we attract a lot of people that are investing in their businesses or are in real estate and others. And so they look at life insurance not as an retirement asset, but they're more interested in, I want an asset that's going to help me long term, but available for me to be able to make moves, to be an emergency fund, to make opportunities. You and I both have lots of money in cash value. You have probably a lot more than I do based on age and incomes and all. But at the end of the day, I look at that as my business war chest. And I want to make sure that if I'm going to borrow against my life insurance policy, I'm getting more than a 15 or 20% return, meaning I'm not just borrowing against it to put in the S&P. I'm looking at what are opportunities that would bring me closer to my living why, And if that's the case, I have cash available on that. So, and you mentioned that while you're not a fan of the concept of infinite banking, that you can use your cash while you're funding it, and that IUL will work better than whole life. Do you want to touch on that before we talk about the next talking point?
Yeah.
I love what Caleb just said there. He and I talk about this pretty regularly. Before Rocky gets into this, I got to respond to this comment here. So Deontay said, how many 0 years have there been in an IUL since 2007, assuming the IUL was tracking the benchmark index participating in each index segment, all 12? The answer is 5 years. So it's been 5 0 years. So the answer here is, you're right, Deontay, 5 years since 2007, which is 17 years. 5 out of 17 is, just about 27%, 28%, maybe 30%. But if you look at how many years, if you have policy loans, if you have policy loans out on a policy, and you then go into the situation where you have down years or not great performing years, the requirement isn't 0. The requirement is whatever the cost of money is, because if your policy loan is 5%, now any year that the market or the index performs at less than 5%, you're going to incur additional charges and costs inside of the policy. And so that's why my buddy Tom Wall always says, if 0 is the hero, then the cap is the trap. You have a couple down years. If you understand how averages work, the cap is going to hold you back, period. It's just going to. And anybody that says, oh, I'm going to work with a non-capped index, well, there's so many other elements of non-capped indexes that I don't have time to get into right now, that I've done other videos on, that show that it doesn't really matter, that you're not going to beat it from a long-term perspective. You're not going to beat the insurance companies at their own game long-term. It just is what it is. So anyway, let's go.
And the concept of the bank itself is it's not an awful concept. I mean, I always laugh at the buying the car every 5 years.
And by the way, I do as well. And I've had videos calling that out, because it's
I'm a business owner. I need a piece of equipment. I need whatever. I mean, there's, it's just money, dude. I mean, whether it's in a brokerage account, whether it's in cash by life, it's your money, and you're just trying to protect it and grow it and use it the most efficient way possible, right? So that's all fine. But yes, you could do the same thing with IUL. So you could start funding $5,000, $10,000, $100,000 a year into an IUL versus a whole life. We talk about the high cash value rider, et cetera. But if you borrow from the policy, you're mathematically, when we get into the probability of return chart, mathematically, you're just going to get a better return than the IUL long term. There's no mathematician.
So this is just fundamentally, mathematically, he's not even accurate. You have the potential to get more. So and this has been my fundamental argument. I'm not going to dispute this. I'm not even going to dispute this conversation. Let's just say mathematically, Rocky's right. I'm going to ask you as the viewer, you as the agent watching right now, you as the person who's contemplating or maybe has an IUL or, is considering getting an IUL right now, maybe debating between IUL and whole life. If whole life insurance long-term is going to get you, let's say 4%, 4.5% long-term internal rate of return, net of all fees. Okay. Even though I did a video where I showed over the past 30 years, the internal net rate of return of a whole life policy with Mass Mutual, and they showed the actual net of everything after all internal expenses, fees, charges, was just over 6% inside of a whole life policy. It's interesting because everybody's like, oh, well, whole life sucks right now. Well, yeah, whole life does suck right now. And the market environment doesn't allow whole life to illustrate very well because they got to go based on conservative current assumptions. We don't get to project it out. It's funny that everybody likes to sell investments looking at 30-year average history timeframes, and they look at market cycles and they look at the way it all plays out. But with whole life, we're stuck to only looking at today's environment because that's the way illustration regulation works. With IUL, they don't have to deal with that because of the fact that they get to, buy call options, and they look at the performance of the S&P 500, and they get to kind of skew and show a higher return based on the fact that they're participating in the market performance with the S&P 500. Whole life insurance right now is illustrating the lowest it's ever illustrated, literally in 90 years, right? So if we're illustrating at the bottom of the bottom, and we came from up here and we're going down there, and we kind of have to go back up, that means it's most likely going to be getting better and better and better at this point in time. So, I mean, or at least, kind of start ticking up. But the bottom line is, when it comes to thinking about like the risk and the return and everything inside of these policies, whole life insurance, let's just say 5% with whole life insurance, that long-term internal rate of return, net of all fees. And let's say IUL has the potential to outpace whole life by 50 basis points, which is a lot, by the way. That's 10% increase, right? And so over time, that adds up to a lot of money. Okay, so let's say it's 5.5%. If you have the potential to do that, but you knew that to get that extra 50 basis points, you had to take on 50% more risk to get there, would you do that? The answer is hell no, right? Like, that's the way I look at it, is like, it doesn't make any sense mathematically. That the asymmetric risk doesn't make sense. You're getting 10% better return for exponentially more risk, comparatively speaking, right? So when you break that down, it doesn't make any sense. That's why I don't understand, what he's talking about. And once again, I'm going to go back to the fundamental belief. This is where I'll say Rocky and I just have a fundamental difference in our values and beliefs. I don't believe IUL is efficient at anything, right? It's not going to beat equities at their game. It's not a better life insurance contract because it's not going to have better guarantees and be permanent insurance that I know is going to be there on a guaranteed basis when I need it to be there, right? Whole life is going to be there. If we look at what we're comparing whole life insurance to, and as far as being a bond alternative, whole life insurance, Tom Wall just did a study that just goes show. And if you don't know Tom Wall, he's a PhD in retirement income planning. And when Tom Wall did this study, and he showed that every 30-year rolling average over the last 90 years, whole life insurance internal rates of returns have beat bond fund returns, which if you look at 60-40 bond funds, right, like that's the 60-40 portfolio, people are using bond funds for that. So it's beat bonds every 30-year rolling average for the past 90 years, right? So whole life beats it better, and it gets you guaranteed death benefit. So it's going to protect you on a legacy and have a tax advantage planning. That's what this is all about. And you can utilize the cash value along the way. So the one thing I have a problem with is IUL doesn't really do anything better. It's not going to beat equities. It's not going to do any of that. It's not supposed to beat equities. It doesn't do anything better than anything, right? Considering the same risk class. And if you're saying that IUL and whole life are in the same risk class, you should just probably leave, because that's just stupid. Here we go. Let's keep going. I got to get over to the other tab, hit play.
Who's going to come up with a way to get whole life to get a better rate of return on cash over time. It's almost impossible mathematically. So if I'm getting a better rate of return on cash, I should be growing my cash more. And then the ability to do variable or participating versus wash loans is a big deal too, where you have that option in the IUL, which we can get into that or not today. But although that is a huge benefit to an IUL, you don't have a whole life, where I have a policy with a 12% cap and I got a loan that's locked at 5.3%. I like that math. I like that gamble better than a wash loan, and maybe even a loaded wash loan at a whole life policy or whole life.
Well, if you do a wash loan, though, the crediting, it's called a wash loan for a reason. Like, you're not going to get that 12% cap on the money that you have loaned. It's going to lower it, wash it out, be even. If you have 5.3% loan, the max you're going to get credited, or you're going to get credited that 5.3% period, it's going to wash it out. And if you decide to take a 5.3% index risk, you may have the ability to earn up to 12% in the cap. But if the market does zero, you're picking up an extra 5.3 expense. You're going to increase your losses by 5.3%. So how he just described that wasn't even accurate. It was actually, to me, misleading and misrepresentative.
So, yeah, you can do.
But the big argument is, if IUL is going to be a better for my future, it grows more, it has better retirement income, then by default, that is going to be better than whole life. And even if I have less cash value in the earlier years and all, that I literally have an asset that's going to be better for the future. And so as a result, yeah, I could borrow against it. There's some flexibility there, but at the end of the day, it's better because we're still comparing it to what it's going to be like at 65 and beyond. Is that, am I?
Yeah, I'm comparing it for your life. I'm not comparing it for the next 5 or 10 years.
No, that's what I'm saying. That's what the 65 and beyond, like that is a metric, is you're very much looking at it future wise versus.
I love this though. Like, whole life insurance has been around so much longer and has success stories, use cases, actual results in the world. Everything that Rocky is talking about is hypothetical, is speculative. He doesn't have one client that has funded a policy for 20 years and had a 20-year retirement and done everything that he's saying. That is my problem. The fact that these people use a speculative product with a contract that is in the favor of the insurance company, and they tell you, and by the way, the products that have a history of performing worse and worse and worse, and yet they're talking about that going into the future. This thing is, just because it projects based on current assumptions that it's going to do these amazing things going forward and that it's going to be there for you for your whole life, he's trying to convince you that in retirement, it's a far superior asset. And there's no history. He doesn't have one case, not one, of a person actually doing it. So, like, I don't see how an attorney can actually say that with any integrity. I don't even know how it's legal. It's just mind-blowing.
I think to do anything other is extremely short-sighted.
Right. Okay. Let's continue, because I have questions, but I want to wait till the end from a standpoint of that. So let's is there any other point that you want to make or concepts?
Well, I mean, we can talk about, just the designs of both policies and why one's probably going to do a lot better than the other, and why the whole lifers hate IUL. And
why do you think the whole lifers hate IUL?
Well, I'm not sure hate's the right word. They hate it because they don't like competing against it. That's part of the industry. That's why we've had our illustration regulations.
Sell it. They anyone.
They don't though. They're just so brainwashed. I mean, again, it's like the cult of whole life. I mean, I convert maybe one advisor every 5 years from whole life to IUL. It's like a freaking cult. If you can mathematically show me why whole life is better, I will start singing the praises of whole life. And I'm an open book, and I'd be happy to have somebody show that to me. Right. But yeah, they can, but they don't. That's what I'm saying. That's why it's sold in a vacuum. Here's your bank on yourself. Here's your. Mm-hmm. They don't show the IUL version of it. If they showed the IUL version of it, 85 to 90% of the people would use the IUL version.
Is there any point that people in the whole life cult make that is you're like, hey, that's a valid point? I don't think that.
Yeah, sure. So let's talk about the talking points, because there's a bunch of them on the website, on the internet. You just Google, why whole life is why IUL sucks, and you'll find all sorts of stuff. Yep. So I think the main one, there's two. One of them is really idiotic, but trusting the company is always the issue, right?
Right.
Just so classically ironic. You're not the national favorite every year. The guy would analyze.
So I got some comments going here. This is fun for me, so I'm just going to do this. So it's interesting. I just wrote this in the comments, but I'm gonna say it on the video here, because I think it is. I think it warrants a moment of time, and I think it's important. So one of the things, so people are saying that I'm just bashing the competition. Where is there integrity in this? If it's stupid, go away, Joel. You don't have to be here. You don't have to waste your time with it, right? The integrity here is actually giving education. The things that he's saying are not accurate, right? They're not truth. Saying that IUL is going to beat whole life long term is a speculative statement, right? It's said with such matter of factness. It's said like it's like an absolute, like it's going to happen, and there's no history of it. There's no example of it happening once, right? And so, like, that's a problem. The fact is, IUL has been around since 1997. It's performed worse and worse and worse every year. Cap rates have been dropped, costs have gone up. They've gone round and round and round about all this stuff. Okay, and so if that's the case, like I said in the comments, my mentor told me back when I first started doing business is, Chris, when somebody shows you who they are, believe them. IUL companies, I got news for you, they are the same companies that sold UL in the 80s and 90s and early 2000s. And if you look at the way that those companies handled all of their clients with UL, it's not pretty. UL's had a lapse rate of over 99%. That's far cry from how they were sold. IULs were sold with upside potential compared to traditional ULs. When you hear the story of upside potential, it's because they designed it to have upside potential based on participating in the indexing strategies, through buying call options, compared to a traditional fixed index crediting strategy inside of a traditional universal life. It's like putting lipstick on a pig. You know, you're dealing with a product since 1997 that's gotten worse and worse and worse, that's performed worse and worse and worse, that the companies have already shown you how they're going to handle the policies because they've done it with a previous generation situation. And yet everybody wants to talk about like, oh, because they're illustrating and projecting like they're going to be this amazing thing, let's just take that as an absolute. I got news for you. They did this already with UL and it didn't go well, right? And so like, I don't know how what I'm doing, you know, I don't know how what I'm doing is not in integrity when I'm actually giving facts. You know, all he's doing is making these stupid, bold statements of absolutes that are not even close to true and have no backing at all. Number one funding reason was underfunding. And the number one reason underfunding happened was because of the fact that crediting rates kept getting dropped. And that's happening with policies right now. People were funding them, target funding them. And by the way, if you call these insurance carriers and they say, oh yeah, you're supposed to fund at target level. That's what, you know, yes, I know there are a lot of people that will sell and design it to fund at guideline level premium levels and all these things, but which is better for sure. But to say that the policies are going to perform as sold and that there's no risk of losing money and that there's not loan risk when you take loans out and that you don't look at like what that looks like from a long-term perspective and you don't take that into consideration and really educate people to all the risks and you try to position it as if it's a risk-free product is, to me, worthy of losing your license. And furthermore, I'll say this. I just had this conversation with Robert Reichard, who is an attorney. He's a number one IUL litigation attorney who has won over 400 cases recently against IUL policies. And it's one of those situations where, you know, the sale of IUL in the way that Roccy is talking about it is the number one reason that he's winning the cases, because this is a fixed product not designed to do all the things that he's saying, yet he's positioning it absolutely like it's supposed to be better. And I don't know how if you believe that this product can give you life insurance, give you the stability and guarantees, be a better income distribution vehicle, do all these things and give you life insurance and all these benefits without taking on risk, like that's just delusional. Like I got a timeshare to sell you or something. Like it's not realistic, right? And so got to take that stuff into consideration. So let's keep going.
The illustrated returns on whole life versus the actual returns on whole life. It was my favorite article that came out every year. It was my most popular newsletter every year because I put the numbers out. The difference historically between with the whole life illustrated with the the whole life illustrated with the whole life actually return was 2% to the negative.
Oh my gosh. Yes.
So I loved hearing these discussions about it. We have to trust the company.
He's not wrong. I want to get
first
in.
and foremost, we are going to put our trust in some company, which is it's tough to say because they never lose. Insurance companies never lose. If anybody's going to lose, it's going to be the consumer. The question is, can we find companies we can trust enough that have done well enough for the client over time to trust them? But what they'll say is you have to trust the company with the caps. Now, we haven't talked about the caps, so the consumers and even some advisors may not know. But so Index Universal Life's returns are usually pegged to a measuring stock index. I don't want to get into a discussion about volatility control indexes because I'm not a huge fan of them. But for simplicity's sake, we're going to use the S&P 500 index as our index.
We agree on that at least.
Minus dividends, by the way. Got to disclaim that, minus dividends. And we're going to have a cap on it. So the IUL product typically is an annual point-to-point, although there are multi-year point-to-points, which I also don't recommend. But an annual point-to-point. So what are we doing? We're going to take our money, we're going to put it in the policy, we're going to have it designed, by the way, with minimum death benefit, usually with increasing death benefit, not level death benefit, maximize the cash for the client and minimize the commission for the agent. So we're going to put it in there. Some costs are going to get taken out, and then they're going to take it, and they're not actually going to put it in the S&P. They're going to put it into income-producing bonds. That's how we do it with no risk. We're going to put it into income-producing bonds. The insurance company is going to buy options on the S&P, which we definitely don't want to get into options, but we're going to buy options on the S&P, a 12-month option. If the market is positive, the options pay off and you get your return. If the market is negative, the options expire and are worthless, but the bonds are still there. They kick off their income every year and they buy new options the next year. So that's how you get a no-risk product with index-type insurance. But there's only so much money to go around. So the way they're designed, to keep a long story short, is there's a cap. So the cap may be, it depends on the environment. It used to be 14%, 13%, 12%, 10%, 9%. So this is the biggest issue that the whole lifers have with IUL. I don't trust the company on the renewal cap because it can change every year.
Mm-hmm. And is it true that there has been companies out there that change their renewals on past clients, but keep them high for new clients?
Oh yeah, I say most of them.
So
I don't disagree with the whole lifers.
okay, so you agree that there's some IUL companies that are playing games?
I'd say most of them do. Yeah, we have a piece coming out that I've been sandbagging because we're getting towards the end of summer and half the industry takes vacation in the summer. So we're sandbagging an article for September where we called we have a top 18 IUL list.
Yeah.
Where we rank them, and we call all the 18 companies. My son did. He's in charge of our life stuff. He talked 16 of them into giving them the renewal cap history. It's I don't know why they did it, but we have the renewal cap history of these companies, and it'll blow your mind. And this actually, it'll be funny when I put it up because all the whole lifers are going to use that piece as a way to compete against IUL. Because they're right.
Video when you come out with that. Let's do a video.
Yeah, he's right. I'm definitely going to be doing that. Like one of the things that I want to do here real quick is, he made a comment, and I think this is really important because I think, the education about this is wildly important. So what I'm going to do is I want to get into just kind of talking about something here. So one of the things he just said that I think is important is he just said that whole life has had 2% less, less. So he's basically said that whole life performed 2% worse, right? So I'll just say worse. 2% worse than illustrated. In the environment, right? And so now here's the deal. That he's not wrong. And I can actually sit here and say I know that to be the truth. And I still love whole life insurance. And I would still put my money into whole life insurance. And the question is, once again, not what did it do, but why did it do it? So a lot of these like IUL agents and people like Roccy like to talk about like what happened or what they think will happen. And they're not talking enough about why it's all happening, right? And so when we look at this and we look at the market environment and we go back to 1979, and I've done this, if you've seen my channel before, you've seen me do this before, and we'll go just 2020 here. And you can see here that the federal funds rate, and I'll go to green here and I'll just change my bar here to green. Federal funds rate, basically went down to 0, stayed flat, has gone up, and now we're at about, 5%, we'll just call it. Here we were at 19%, okay? So we went from 19% to 0% right here, right? And during that time, what happens is whole life insurance companies can only be illustrated based on the year that you bought it. So if you bought in 1990 a whole life policy and the dividend rate was 10%, we'll just say the dividend rate was 10%. Well, if you look at an illustration, it says that the current assumption in a whole life is assuming two things, two assumptions. Number one, a dividend is paid. That's it. A dividend is paid. This is one of the reasons that I say you have to work with a company that has always paid a dividend at least 100, 110 years or more, right? Like that is key. And number two, the dividend is paid at current levels. Okay? So when Roccy is saying that this whole thing about performing 2% less than it was illustrated, well, it's because we were in this environment where people are buying here and the rate is going down. And so as the fixed interest rate environment goes, because what he just said is absolutely true, companies buy bonds, bond rates go less, general funds performances go down. So only one out of the two things happens in the current assumptions. The dividend is paid, but it's not paid at the current rate, this 10% dividend. What happens is that 10% dividend goes down to 9, goes down to 8, goes down to 7, right? And right now, it had been lower over this decade. It had trickled down. It got all the way down to, for some companies, into the 5.2% range. And that company has actually just increased it to 5.75. So what's really cool, think about it this way. For all the people that I ran illustrations for last year and sold policies to at 5.2%, already this year, it's gone from 5.2 to 5.75%. The dividend has increased by 10% already in 1 year. And so during this spectrum of time where Roccy is getting this stat showing whole life doing 2% worse, during that period of time, yes, whole life insurance performed worse, right? Like because, and it's going to be 2% worse because dividends took it on the chin, right? That's just the way it is. But here's the deal. The thing that impacts the dividends is only one part of the equation for an IUL. The dividend that goes into a whole life basically equivalates to the options budget for IUL. That's what they're doing. They're going to take what they would normally give with a fixed credit in an IUL, and they're going to go buy call options. So then you got the call options costs, right? And all these things have to come into play. And then you have market volatility. You have so many variables that are going to come into play here. But I think it's important to understand with what he's saying. This is why I'm so bullish. I did a video with Tom Wall. It said, now is the best time in 90 years to buy whole life insurance. Why? Because everything Roccy is saying right now about 2% performance of under, even though it was really good. Like I just did this conversation, right? I just did this conversation a couple minutes ago saying that Mass Mutual did a piece, 6.18%, right? I think I did a video with Hazeltine Financial on this. 6.18% was their 30-year dividend. That internal rate of return 30 years in a Mass Mutual policy was 6.18% as of 2016. But if you go back from 2016 to 1986, right, and you go back to 1986, right, in 1986, and you bought that policy would have had probably an 11 to 12% dividend, right? So it's illustrating, my guess is the internal rate of return of this probably showed 10+% or maybe 9.5+%. So if you go, I bought this assuming that, right, this 10%, but it really only did 6.1% over the time. Well, then you're going to be pissed off if you didn't really understand what you were buying, how it worked, why it did what it was going, right? And it's just like, it's just insane to me that people aren't digging deeper, right? And when we look at how this works, right now is the best time to buy. Why? Because we're at the lowest rate environment right now. It's going up to 5.75 right now. And we're at the lowest rate it's been in history. So what you see on paper, I'm a big believer of looking what's the upside, what's the downside, can I live with the downside? And what you see on paper is as solid as you're going to get of an asset, right? We're not trying to build wealth in here. Roccy, says he could beat the pants off of whole life according to everything right now. Well, guess what? With whole life, when the insurance company increases this dividend to 5.75, you capture it. With IUL, you're still taking now this 5.75, which is basically what the IULs are illustrating at right now, right? Is 5.75, maybe 6% for the companies that aren't as ethical, right? They're going out and they're saying, oh, you might get 6%. Well, whole life now is at 5.75 instead of the 6. So the 6, is 25 basis points higher. Are you willing to take on 5 times more risk for 25 basis points of potential higher long-term return? That's my question to you. And if the answer is yes, I think you're a little crazy personally, right? I do. But then as long as you understand all the variables that we're talking about, that's your risk to take. That's up to you, okay? And that is it. The other thing I'll say is that I have a problem with the IUL is when you get into retirement and you think you are safe, taking retirement income every year from an IUL is the most certain way to run into problems. It's the most certain, So anyway, let's keep going. I know this is going long. Guys, you can tell me if everybody wants to take a break and me to split this up into 2 videos, we can, but I enjoy this kind of stuff. So I can do this all afternoon.
Oh my gosh, it's going to be hilarious. So, we started at 12 and now we're 8.5.
Yeah.
We started at 13 and now we're at 9. We started at 11 and now we're at 7, whatever. So yeah, I agree with the whole life that it is an issue.
Okay.
But I also think it's a two-faced discussion because we're putting our trust in the insurance company to pay a dividend that's not guaranteed.
Okay.
So I don't want to hear how we got to trust the IUL company. And we can't trust the IUL company, but we can trust the whole life company. Because
Is there any difference in
How can we not trust the IUL company? Hold on. How can we not trust the IUL company, but trust the whole life company? Well, I mean, let me start with the whole life company has paid a dividend every single year for 110 plus years consecutively without missing a dividend. And so they've got a track record of success. And the IUL company has a track record of getting worse and worse and worse, dropping cap rates, increasing costs, like just underperforming its promises. That's the track record. So how can we trust a whole life company over an IUL company? I think history says it all. Like, I don't know why that's so complicated, Rocky.
in your opinion about, and again, this is another talking point where it's like participating whole life, you're a part owner of the insurance company versus IUL. You're not.
You should buy a stock company because they're much more profit driven and not interested enough in the policyholders because policyholders don't own the company. The stockholders do. I don't buy in any of that.
You don't buy it. That doesn't move the needle for you. Okay.
No, although there's a guy out there's totally disingenuous in that space, only pitching mutual companies, and ironically, it's like a company he's got a high contract with, and nobody really understands it, and he's trying to funnel money in the small whole life company. That's why I wrote bad advisors. Okay. But so again, this is the one talking point. One of the two main talking points with IUL is the cap renewal, and I don't disagree with it. Okay. So we do the best we can to find the renewal rates, the published renewal rates, the verified.
I don't know if you guys know or understand what cap renewal means. If like I did a review on this and I basically showed, and I'm going to go back here. I got to just show this just for a second. I did a video on this recently, and in the video, basically what I showed, it was a nationwide policy. And this is a big deal. So Nationwide did a policy, and right now I think their cap rates were like 11% on their current products. Okay. So this is what they're marketing, right? So this is what they're marketing to sale, right? To their clients. But the problem is there was a guy who had a 7.5% cap. He bought it, originally purchased in 2018. And when he originally purchased it, it was a 12% cap. Okay. And so the 12% cap dropped to 7.5% cap. So what is that? That's a huge drop, right? Like this gap here. And by the way, this was illustrated with, I think, a 7.4% assumption based on a 12% cap, right? And they said, oh, this is conservative because like you look at the history of the S&P 500, this is the challenge, right? That you look at that and people think that that's, that 7.4% number is reasonable because of this 12% cap in the history of the S&P 500. But the bottom line is the cap rate risk, what Rocky is talking about, is real. They keep them high to market because otherwise you could never sell a 7.5% cap product. But almost inevitably, they're going to launch a new product, sell it at a higher cap rate, and drop your cap rate to 7.5, And what happens is when your cap rate is the same amount that was illustrated, this policy never has a chance. It's like dead man walking. It will lose and fail every single time. And this is what happens across the board. So the market performance, the index performance has very little to do. And your advisor, no matter how smart they are, no matter how you design it, like those are risks that you can't avoid, period. You're saying I have no idea what interest rates are going to do over the next decade. If the equities market crashes, Fed will likely introduce ZIRP. Yeah, you know what? They could go back down. You're right. But if it goes back down, what's going to happen is you are going to have a reduction in cap, or you're going to have a reduction in the options budget as well, which is going to reduce cap rates and all that stuff. All of your statements, Deontay, have just been defensive, and there's no actual physical backing or like backing of any math that shows that there's proof behind what you're saying. So, that's show me some proof. Like everything I'm hearing from everybody that's defending IUL, which is supposed to be the safe, predictable, dependable product, everything that's defending IUL is speculative. Everything. So that's my biggest problem with you guys, is that you speculate to defend and you talk about it like it's an absolute, right? Like how do you not see that? And how does that not drive everybody crazy? Why does it drive me so crazy?
Renewal rates of these companies, we only use the ones that we think are going to keep the caps high. And we use one that has been the best in the industry going back 14 years. They're also the only one who formally on their own without us bugging.
I agree with you. Illustrations should not be illustrated above 5%, Deontay. And if you can illustrate an IUL at 5% and you're comfortable, and 5% every year, that's the number you're comfortable, then if the client understands everything and it's illustrated at 5% and they fund it properly and they understand all the risks, then God bless you, take that risk. You're certainly mitigating a lot of the risks. I will give you that, Deontay, okay? But nobody's doing that. Nobody's illustrating these things at 5%. Or really even a lot of people that are not selling, really educating to what the risks are. And furthermore, if you're illustrating at 5%, when dividends in whole life are at 5.75%, when we're talking about a foundational asset, why would you take the risk on an IUL compared to a whole life? It just makes no sense. Because if you're going to show me an IUL illustration at 5%, I'm going to beat you with whole life the way we design them. Like it makes no sense. It just makes no sense. Like, I don't even understand why you would want to do that. IUL would never win.
And then publishes the renewal rates.
That's
and the lowest cap rate in the last 14 years has been 12%.
Okay.
Now, is that going to continue in the future? I don't know. Is the dividend from the whole life company going to continue in the future? I don't know. But it's great to have a 14-year history and they're the only company that publishes the renewal rates. Now, there are others out there that we trust, but it also has a good design. So that's talking point number one that we have to dispel. Or if you can't get over that and you somehow trust the whole life company on the dividend better than the company on the cap, that's a reason you may use whole life over IUL. The other one that annoys me to no end is the increasing cost of insurance. That's the other number one talking point. Well, whole life is basically, if you're a consumer, this will make a lot of sense, but think of a whole life policy with a level cost structure with a flat line. Like it goes like this, right? So early
you're talking about like if people sell whole life and the death benefit doesn't increase.
No, I'm just talking about the cost of insurance.
Okay.
Cost for the death benefit, you bought whatever it is, whether it's 100,000, 500,000, or $1 million. If you look at whole life, it's very expensive early on with the cost structure, but as you go on, as compared to like a variable life policy, like variable starts extremely low and then goes like this, right? At the end, it's basically annual term.
Yeah.
So the annual term for an 80-year-old is very expensive versus the annual term for a 40-year-old. Whereas whole life is like a straight line. And the whole lifers say, well, we don't trust the whole life company or the IUL because we think the costs are going to get out of control. When you hit 80, when you hit 85, it's going to be, the cost of insurance can be so expensive, it's going to destroy the policy, right? Whereas whole life, it's the older you get, by comparison, the expenses are less because it's more level cost structure. And to some extent, that's true. It totally ignores the concept of net amount at risk. What is the concept of net amount at risk? It's the amount that the company is on the hook for the death benefit. And it's very high in the early years. Well, I paid a $10,000 premium. I was budgeting that for 7 or 10 years, and I bought a $500,000 death benefit. Well, guess what? In year one, the company's on the hook for $490,000 worth of death benefit, right? But I paid another premium, and I paid 10 years worth of premium, and I paid 15 years worth of premium, and I had my cash increasing. And when I hit age 85, the corridor, the net amount at risk for the insurance company went from this to this because I have significant cash in there. So yes, the cost of actual insurance is higher, but the amount of death benefit the company is on the hook for is very low. And when you run all the numbers and do the comparisons, that's really a misnomer and a red herring, a talking point that insurance agents say, but they don't really understand. Well, the insurance cost in the IUL are much more expensive in retirement. True. But the amount of coverage that the insurance company is covering you for is extremely low.
So what he's saying there, though, is kind of backwards because it's not the risk to the insurance company that I'm concerned about. It's the risk to the policyholder. And so the risk, you can close a corridor. I've done a lot of videos, had a lot of conversations about this. Close a corridor, you could shrink it. If you have $1.2 million, a lot of times it's somebody who's in their 80s, you could shrink that down to having it so you only have like 100, maybe 75 to 100, $150,000 of insurance, right? Like you could shrink that corridor really significantly. Challenges at 80 years old, the cost of insurance on $100,000 is still really high, comparatively speaking. We're compared to, the fact that you have like $1 million of cash value, you're still talking probably a 5%, cost of the insurance compared to what your portfolio value is, or maybe like 3 or 4%, which is extremely high, like when you break it down. And the fact he's not talking about the risk involved with income out and having all the loan risk that goes into it at the same time, and how that impacts the net amount at risk, and how that impacts all the moving parts. When you put every piece of the IUL in a silo, it's easy to have a conversation and defend the perspective. But when you look at them all together and you put them all together and realize that the net amount at risk conversation, reducing the corridor, the loan risk that comes into play, all these things that happen, the ability for the companies to reduce caps, the ability to increase loan rates, all these things that come into play, when you look at them all together and you look at all the variables and all the moving parts that the insurance company has the ability to change to your detriment and their protection, right? Not advantage, but protection. When push comes to shove, they're going to protect themselves. That's just the way it is. Whole life insurance, that cannot happen.
Just to you have $1 million of cash value and your death benefit is 1.2 million and you're 80 years old.
Exactly.
You're not paying the insurance premium on 1.2, you're paying the difference, which is 200,000. And so that explains the net at risk for the corridor of insurance.
Yep. But
so it's fair to say if you're working with a good advisor who's monitoring everything, that should not be a risk. But is it also true? Have you seen IULs out there that have not been managed well, or that are set up with level A? Just have you seen? It's not like you're an apologist for IUL, period, because there's probably a lot of bad examples in the IUL space of people not managing it well.
I'd say that's more the norm than the exception, that it is managed poorly, that most advisors recommend level death benefit versus increasing. There's not the problem with recommending increasing, but like I just had a call with a client. I guess I've had clients in the past that used to actually have real clients versus just advisors. He's in the 13th year of his policy. He's not paying premiums. And he calls me, he's like, look, let's have a chat about what we should do with this policy. And one of the things we had a chat about was turning off the increasing death benefit. Right? Because we went with increasing and now he's done. And if we don't toggle it from increasing to level, it'll keep increasing. So it's one of the things you have to do. You have to manage the policy. You have to manage the premiums. So, we're always running them at the MEC minimum, amount of economic contract minimums. We have the minimum amount of death benefit with increasing death benefit versus level. So we're really trying to minimize the cost for the client. You have advisors out there who's like, well, he might want to in the future or she might want to put more money in there. So they don't actually run it at the MEC minimum. That's their excuse for just getting more commission because they have a higher death benefit. So I would say both with any life insurance policy, the norm is that it's not been set up correctly, that it's not being managed correctly, that it's not been sold correctly, but yet they continue to make deals.
Another talking point that I hear is if IUL is not set up properly, not funded properly, that it could blow up in the future. Have you seen any IULs recently that's been the case, or is that just a fear-mongering talking point?
That is such a fear-mongering bunch of nonsense. If you design it properly...
That's what I'm saying. You don't design it. You design IUL.
Yeah. Well, of course. So
you could design it properly. I got news for you. I'm doing a series with an attorney right now who's won hundreds and hundreds and hundreds of cases, even against people who are designing policies properly, max funding to the guideline level premium, all these different, strategies that people that are saying that you can design it properly. And we're doing a series and we're going to go through cases that he's actually won. So make sure you subscribe and hit the bell to get notified when they come out. But he's just, once again, he's completely speculating and making it sound like it's fact. And there's no real history to back up his point. He's got no evidence, Mr. Attorney. You have no evidence, yet you're speaking like it's fact.
You had far too much death benefit. You didn't put enough premium in. Guess what? It's probably going to blow up. Now, the other thing you also hear from extremely ignorant whole lifers, they'll harken back to the IULs of the 80s. You're a little young for that.
But I've heard the talking points of
So we sold IUL in the 80s. Well, I didn't, but we sold IULs in the 80s when interest rates were 18%. And the returns on a traditional UL, universal life versus an indexed UL, it was basically based on bonds and interest rates. And they would do the dumb thing, which is we're going to project out 18% interest rates for 40 years, and we're going to do minimum funding. Now, back then, they weren't really using it for cash value per se, but they were doing a minimum funding for death benefit. Oh, you mean I can pay a premium of a single pay even of, $100,000, $50,000. I get all this death benefit, and based on the 18% interest return projection for 40 years, I never have to pay another premium. And then when interest rates came down, and nobody was paying attention to the policies, they all blew up. They all died.
Mhm.
They all got surrendered because I was only getting a 6% credit rate instead of an 18. I did a single pay or short pay. Nobody was paying attention. And then the client all of a sudden gets a call for premium. So we'll have a whole life agent that says, well, these policies will blow up. A lot of them are harkening back to the 80s. If you design an IUL at the MEC minimum and you're funding it properly, there's virtually no potential.
This is I have a couple questions, but no, I think believe it or not,
By the way,
I agree probably more than you think.
I agree with him to this point. If you max fund a policy and you never utilize it for cash value and you never utilize it for tax-free income in retirement, then your risks in an IUL are very negligible. But the bottom line is people are utilizing it for that. That's how it's being sold. We do sell IUL occasionally for estate planning because there are IULs that you can utilize and put guarantees on them. And you can make sure that death benefit is going to be there. And there are ways to design them to have it be a more affordable cost structure than a whole life policy from a long-term perspective, whether it's an IUL with a rider or a GUL policy. A UL platform with those guaranteed riders can be a better play for an estate planning situation. But when it comes to utilizing the cash value, that's where the risk comes in, right? So if you're doing what he's saying, he's not wrong. Like, you're never going to have a problem if you fund it properly, as long as you never touch the cash value. But also go back to the 80s, nobody was buying them to invest from a tax-free income at retirement perspective. Like he said, it was just for the death benefit. The risk now is so much more than just what he's talking about. It's the loan risk and the combination of the reduction in cap rates. And as the reduction of the interest rate environment has happened, that does negatively impact the options budget, which will reduce the cap rates. And that's why IULs have had the problems that it's had so far. It just happens to be that they've been bailed out by the greatest bull run of all time. So the returns have been decent enough because there really hasn't been too many negative years or flat years.
Because I have a good friend who works in family office space, and he does both whole life and IUL for very wealthy families. But he's one of these nerds that like look at actuarial tables, probably very much like you, and just like he's like looking at it less from an illustration and more of like actuarial curves and figuring out all the stuff. And he's like, hey, he prefers IULs in many cases because you can be a lot more flexible. And so when you're dealing with the super wealthy family, it's like, I would rather have the flexibility and all these things. And we've had conversations and it's great. But he's like for mass market, his problem is like there's a lot of multi-level marketing companies. There's a lot of people. I mean, getting an insurance license is not hard. You get an insurance license, and then a lot of times the companies that pay you the most are the crappiest. Right? It's crazy how that works.
Transamerica.
I don't need any more letters. So. No,
that's Rocky's opinion, not
that's it.
Not BetterWealth.
Send Rocky the letter. I don't need another letter.
That's what the WFG group uses.
So the point that I'm making is then you just get a lot of people that, number one, aren't going to be in the space. Over 80% of advisors aren't going to last. You have consumers that don't know what they're getting. You have products that are inferior, and most likely they're not optimally designed. And so you understand that like you have the perfect storm of a train wreck, and who does that hurt? That hurts you, that hurts me, that hurts everybody in the space. And so I think I don't have a problem. I'll just go on record. I don't have a problem with people like yourself, people like my friend who works in family offices and all that do like they're looking at products and they're using it, but they're like staying on top of it. They're optimally designing it, and they're like that's one thing. But I think we can all agree that how many percentage of advisors are actually doing the right? Is it less than 10%?
Wow.
Way less.
5%?
Well, I'd say it's probably 15%.
Okay, 15%. So that means there's 85%.
Well, my whole life because my
no, I'm just saying like you understand that it's less of an IUL whole life, it's more of an education thing, and it's one of those, if you are an uneducated client, what is a product easier to sell? I would say it's IUL. Like IUL is easier to sell than whole life. It's like you get upside, no downside, and the illustration look better than whole life. What product am I going to rather sell? Like, it's easier to sell IUL. The point that I'm making is I don't have a problem with the conversations that we're having. I just have like the bigger issue is there's a lot of people getting into products, life insurance products, whole life and IUL, but I would say more IUL that are products that are garbage. And it has nothing to do with your skill sets and what you're doing with your clients. It has more to do with the industry as a whole. Thoughts on that? And because I don't think people are attacking you when they're talking about the talking points. They're talking about there's so many companies that you're going to come out with that are under delivering on their promises. Yeah. And it's like, yes, if you're going to do IUL, work with someone like Roccy. Like that's why I'm saying this on my show. But it's like the issue is you would even have a hard time putting up a billboard saying certain of these statements, knowing that if people don't work with you or someone that really knows what they're doing, that they might not be better, their outcome might not be better off because they just went down the IUL.
I don't disagree with anything you just said. The only thing I would, maybe living in the bubble that I live in, I'm always assuming that clients are going to get good advice from us and our team and the advisors in our realm. Because we do have an insurance marketing organization, and we don't let unsuitable sales go through. So in my world, when I'm talking about whole life versus IUL, I'm always assuming that the IUL has been sold properly.
Yep.
Right. Which I agree with you. I don't think is the case most of the time. So if I were to improperly sell a policy, you would be better off improperly selling whole life as long as it was funded properly, because it's fairly boring.
There's less levers.
You're not going to get hurt in it.
Less levers.
That doesn't sway me from saying that whole life is still a better product.
Because
I should sell whole life because I'm an incompetent insurance agent and I don't have the capability of finding the right IUL. To me, it's a great, way to go.
I just wanted to. There's a theory to this conversation. That was like the first thing that I want to knock over. The second point that I want to make is the belief in insurance.
Before he says that, what I want to say too is like to think that you as an advisor are going to be able to outmaneuver the life insurance company when they control the variables to how the policies work, by managing the policy for your clients from a long-term perspective, is just not realistic, right? Like, so even to the point where if you go through a lot of the people are selling these no capped indexes, right? Like, and that's really where people are making a lot of sales right now on these IULs is selling the uncapped indexes, because like the ability to like earn this possible 25% return annually inside the policy. One of the variables and levers that the insurance company has to be able to move inside of the policy is to completely change and remove certain indexes from the index options every single year. So you might buy a policy right now. Think about this. You might buy a policy for the fact that you love this one index, and that's poker tell big time. But you might buy one of these policies because that index was what was sold to you, and that's the power. Are you aware that 4, 5, 6 years from now, that index, the insurance company has the complete contractual right and ability to remove that index as an option for you, yet you're stuck in this policy, right? So these are things, once again, when we talk about infinite banking, when we talk about a foundational asset, we're talking about need for predictability, consistency, and control to help us show up better and more powerfully in other areas of our lives. That's why IUL doesn't work for infinite banking. Let's let Caleb continue.
Companies long term, and that's you just said yourself that you're working with a company, maybe two companies that have published their 14-year track record, and it's been amazing. Is that fair to say? Like
one in particular, as others, we know the ones that have a good track record. Let's put it that way.
But is it also fair to say that 14 years is a very short period of time when we're zooming out on like real track records? And if I'm 28 years old, we need to make an assumption that the world that we know it today is going like that. I am betting on this company to perform. And here's my big deal. And this is why I'm not even a big fan of life insurance selling it for income. Is I just don't know, like I just want as much flexibility as possible. So I would prefer having earlier cash and flexibility, which you can do in an IUL, by the way. And I would rather have more cash and flexibility than a potentially higher income, mainly because it's like what's the phrase? You get one bird in the hand, versus two in the bushes. And I just have this fundamental like distrust. And the thing is, you are one of the most distrusting people I know, but I take that as a compliment. But it's like, how do you feel like as these leaders?
No, I totally get it. Let me answer your question. So it is an issue. We are talking about people that are going to hold these policies for a lot more than 14 years.
Right.
The surrender charge on the policies, depending on the policy, usually is 10 to 15 years. And when you get out towards your 8, 9, 10, the surrender charge is very low. So if you got to the point where the company wasn't treating you fairly you just 1035 exchange. You could 1035 exchange the whole life.
Yeah.
Now I have an advisor we work with. All he does is do 1035 exchanges of Northwestern Mutual policies from Northwestern Mutual Whole Life to IUL. That's all he does for a living. And he's so freaking busy because it's so easy to show in-force illustrations from a cash flow perspective, how inferior Northwestern Mutual Whole Life will be to
That
even
guy's
a decent
exposed to
IUL.
such a
So
lot.
again, I'm just a mathematics and a probability guy. I just run the numbers. Even if the cap goes, look, that's the thing. Even though we talk about dumping caps, right? Even if they're lousy cap rates that these things are renewing at with even the bad companies, you're still going to get a better outcome than Whole Life.
You're assuming that
that is absolutely not the case.
No,
So
I'm assuming even if you lower the cap.
What he just said, I just showed you one example, right? I just showed you an example of the cap rate going from 12 when it was sold to 7.5. A 7.5% cap rate has no chance of competing with a whole life policy. So that statement is the most idiotic statement I've ever heard in my life.
To 8.5 or 9.
No, but I'm saying like, what happens if they keep on lowering the cap? Like that.
Look, they've been around since the late 90s. So they've been around for over 25 years. You do have to play on the greed of companies at some level, like their self-interest to continue to survive, assuming they're financially stable. That's, using A and above rated carriers or whatever. They all can't dump their caps.
And because then
somebody's going to step in with opportunity.
The free market will keep them in check, because if you're underperforming,
That's not the case, though.
Is there a world where insurance companies?
Like, what happens is they dump the caps, right? But the thing is, they dump the caps, and there's a surrender charge. There's a surrender cycle. So, oh my gosh, like this is so frustrating. Like he's not even being accurate, right? Like, so I gotta go here. I gotta do this. Okay. So right now, what he's saying is that let's say you bought a product, and that product you bought with a 12% cap is when you purchased. Okay, you purchased it with a 12% cap. Current at year 6 equals is 7.5. That's what we're dealing with. Okay, so the cap rate reduction is significant. So what he's saying is like, Rocky says 1035X. No big deal. Okay. Just go 1035 exchange it. You'll take care of it. If that really happens, you want to reduce the risk, just go do this, go, no problem. But the problem is, let's say you're putting 20,000 a year in. You're 120,000 a year into the, or 120,000 total into the policy. And let's say your accumulated value equals, which accumulated value is what you're earning credits on and so on and so forth. Let's say that's at about 110,000, let's just say. Okay, let's say it's designed well. But now your surrender value equals, let's call it 85,000. Okay, so what happens is now you look at this and you go, oh my gosh, if I want to 1035 exchange this, I can't 1035 exchange the full 110,000. I can only 1035 this 85,000. So I have a $25,000 decision. Do I want to keep throwing good money after bad, or do I want or do I want to walk away from this 25,000 and 1035 exchange it? That's the problem. So what he's saying is bull crap. Listen, if this policy is 10, 15 years old and you discover it then, well, yeah, he's not wrong, but you've already lost so much more and you're in such a worse position. And by the time you found out, you were basically financially massacred. And it's horrible. So the disingenuousness of these comments is just insane to me. Anyway, let's keep going.
These want that to take liability off their books, to say like, hey, I'm going to force you to leave because I don't want the liability.
There's almost no liability with these products. That's the beauty of it. There's very little downside for the insurance company. There's no risk to them. The risk
other
is
than a quarter of insurance, which is very low.
Yeah, that's not a risk because they're charging for it. The risk is the option costs.
That's true.
There's virtually no risk to the insurance company. That's the beauty of it, because they pass it on to the consumer. There's option costs which change, right? There's bond income that change. So what's the bond income and what are the option costs? Those are the variables. Yeah. And they're just going to pass them on. So there's no risk for the carrier. Yeah. They just pass it on to the consumer in the form of, we didn't have as much bond income and the option costs were too high. Therefore, your cap this year is 8.5 instead of 9.5. So to me, all that discussion about companies getting out of the business and being risky for them, it's not. It's a very profitable product for them.
Okay, so
Whole Life was very profitable for the Whole Life company.
Right. Two other questions. So some Whole Life purists will literally say that Universal Life, Index Universal Life, is sold as a permanent product.
It's not. It's not a permanent product, and nobody should ever sell it that way. It's not.
Okay, so you're one of the first people, but you would say that Whole Life is a permanent product.
Yeah. If you fought Whole Life,
interesting. So I appreciate you saying that, because
there's no other way to say it that's technically correct.
Okay. So there's many people out there that would not have said what you said, so that's a part, and they just look at it from a philosophy standpoint.
Contractually, there's no other way to have it.
Right. They from a philosophy standpoint feel like it's going to ruin it for everybody because it's going to make all like it cheapens the word permanent. So we already talked about that.
By the way, you can get an IUL with a permanent rider, a permanent death benefit rider.
Yeah,
which is the way
it's not an efficient way to use it. That's a whole different discussion about whole life or death benefit versus guaranteed UL. Because you can get a guaranteed UL death benefit guaranteed by the company, much less expensive than a whole life guarantee. So
the last thing I'll say is just the philosophy of like the levers that insurance companies can use. So and this is I will throw shade to the whole life side. A lot of people say like whole life is number one, it's black box, so it's hard to see. Like IUL is a lot more transparent than whole life companies. The other thing is people say like cost of insurance can't go up and all. They can lower the dividend to do whatever the heck they want to do. So just to be clear, like the insurance company can lower the dividend and they don't need to call it a cost of insurance, but the insurance company, so any insurance company will make the product worse to stay in business versus, so just to be like very clear with that,
For sure. He's 100% right. They can, but this is where we go. Why would you trust the whole life company over the IUL company? Is because there's 110 plus years of track record and success and trust and dependability and actually building a reputation that you can actually lean on, right? It's kind of like when you first met your spouse, you didn't trust them as much as you probably do now. I didn't trust my wife as much year one as I trust her now, 23 years into our marriage, right? Like it just didn't work like that. Like it takes time to build trust. Furthermore, Rocky likes to downplay and say, the conversation about being an owner of the company, basically as a policyholder of the participating mutual company, the company can't hurt them without hurting you, right? Like it's a symbiotic relationship where you guys are tied together. With a stock company, you can get hurt as the policyholder, and yes, they're concerned about profitability. The profitability of an IUL company has nothing to do with your success. Nothing, period. Like the IUL company can be profitable and your policy can still fail. Make no mistake about it. With a whole life policy, as long as you do your obligation and fund it properly, the whole life company cannot be profitable without you being profitable, period. Like that's just the way it goes. And you can't downplay that. He tried to be like, that doesn't matter to me. Well, I'm glad it doesn't matter to you, but like with a lot of the other things you've said, Rocky, like your opinion really doesn't matter to me.
But IUL carriers, especially for you that you're saying, hey, mutual does not move the needle for me.
No.
You could make the argument that insurance companies, especially with all this PE money and all this stuff going on, they could, if they wanted, if you get an executive who's, just wants to, like, it would be easier to manipulate an IUL stock company versus a whole life. And I really do believe that. Like, there's more levers that you could pull. Now, you could say, hey, we have a 14-year track record or a 30-year track record of these companies not being able to doing this. But like in the next 50 years, the likelihood of a stock IUL carrier changing something is higher than maybe a mother mutual company. Was that a fair statement? Or
there's nothing to change, man. The only thing that changes is the cap.
The cap. Could you change the annual renewal? Like, could you increase the cost of insurance for the net at risk?
Yeah, if the company was going bankrupt, you could go file with the state and try to raise your rates. I've never heard of an IUL company doing that in 25 plus years.
So you're saying the biggest lever is they could just lower the caps, and that's like
they don't need to manipulate anything with the cap.
Okay,
and they can. And some do, and the ones that do make more money because they're
long term they don't. Maybe long term they don't, unless they're just their whole strategy is get incompetent people to sell products, get out of the business, not pay them renewals, and people.
I think there's several. I think there's several in that business now.
Yeah. Okay.
Yeah.
Well, Rocky, I appreciate your time. The goal that I want to do is actually take you up on your offer of like, let's get some examples and show like, hey, person A, person B in different scenarios. I know that you're open for a conversation with someone who's maybe a little bit more educated or heated on the other side. And I would love to host something where we can maybe a longer form conversation. Maybe if you have questions, I would love to hear from you in the chat. Rocky would also love to hear from you. So if you're like, Caleb, you totally missed this point. Rocky, like you totally undersold this point. Please let us know. This is not going to be the last time we have conversations. Like I said, we're going to be in a series.
I dare you to have a conversation
where we go through bad schemes. Again, we're going to think of this as like a trailing, like where we'll take Rocky's newsletter and make videos around it. And so again, if you're an advisor and don't get Rocky's newsletter, do that. Like pause this video and make that happen. There'll be a link down below if you want to learn more about how you could work with Rocky's organization as an advisor. There's that. And if you're a consumer saying, hey, I really want to talk to Rocky or someone on his team about my situation, or hey, I really want to do IUL. Like this resonates with me. We'll have a link where you can meet directly with Rocky or someone on his team. And again, my purpose is to increase conversation. And that's why I have you. When someone heard that we were doing this, they thought I was out of my mind. Right? They're like, why would you bring the enemy into the game? I'm like, I do not see that. I don't see that because I believe that people are smarter than I think we give them credit for. And I think we will benefit by having great conversations. And look, Rocky and I don't hate each other back. Yeah, I survived. I think we'll see. The comments will let me know if I survived or not. So any final words that you want to say? And then also last plug I want to make is if you have a talking point or if you have a subject that you want Rocky and I to cover, insurance companies, scams, estate planning. We're going to do stuff on Roth conversions and all that. Please let us know.
So he's just closing the video down, but and it was good. Caleb finally started, holding a little more posture as to his beliefs and what he was trying, what his perspective is on everything towards the end of the video, maybe like the last 15 minutes, which I think is great. I don't know why he was being so wishy-washy at the beginning. But I'll say this is I'm always down to have a conversation, right? Like, so, Rocky, if you want to have a debate, a conversation, you want Caleb to moderate it, whatever, I'm happy to do so. I said this at the beginning, like, I think there's just fundamentally a difference in values and beliefs, I don't believe, and Caleb, I think you don't believe that you should ever utilize life insurance as a consistent stream of income in retirement. I think if you look at the illustrations that people are buying for IUL, the illustrations would even say doing this injects a lot of risk to what you're doing into your plan. In fact, taking loans in IULs will disrupt some riders. It injects a lot of risk into the policy lapsing. And if you look at the overloan protection rider, if you run into a policy lapse issue before you're 75, there's a tax consequence that comes along with it. So I would say, from everything I heard from Rocky, it's just a wide chasm between our values and beliefs in how we think things should be done. Life insurance do not create big returns well. They do one thing better than any other financial institution in the world is they create the best possible return with the least amount of risk possible. And so for me, I want to partner with them how they do that. Make no mistake about it. He downplayed the fact that life insurance companies are, the mutual versus participating mutual versus stock companies. He's like, I'd rather be with the stock because they focus more on profitability. Yeah, they do. For the shareholders, you can have a profitable stock company and have your policy get punished in the process. So the fact that he even said that and doesn't realize what he said is wildly concerning to me. So anyway, I'm going to leave it at that. Any comments? Let me see if I got any comments before I roll. Yeah. Anyway, I'm not disappointed in Caleb. I mean, I wish Caleb's like my brother, man. I love the guy. I just wish he would be a little more bold in certain situations, but I'm working on that. We'll make it happen. Andre, my dividends will come from your IUL lapses. I love it. All right, guys, everybody, thanks for the comments. If you, like I said, I mentioned this a couple times in the video, I'm doing an interview series for all the things, Rocky is an attorney. He's a recovering attorney, as he likes to say. So he's no longer an attorney, or maybe he still is. I don't know how he's got all that set up, but he runs a life insurance IMO that sells IUL. I run a life insurance IMO that sells whole life and term. I'm not going to hide from that. This isn't me bashing my competitor. This is just facts versus facts, and or facts versus half truths, and him speculating versus me being like, it's just read the illustration. If you read the IUL illustrations, everything he says is basically like, I know the illustrations say all these things, but just don't worry about it. I'm not worried about that, so you shouldn't be worried about it. I'm an attorney. Well, I've got another attorney that I'm going to be doing my own series with, and we're going to be talking about all the lawsuits that he's won against people like Rocky. And I'm not saying Rocky has been one of them, but I'm saying IUL agents that have sold these IUL policies and then have had all these problems even when funded properly, right? And so the reason I'm so passionate and so against all the things that Roccy has been speaking to in this video is because I've got so much experience dealing with the other side of it. I've got so much experience having conversations with this attorney Robert Reichard, who's going to be coming on the channel, who's sued and won for hundreds and hundreds and hundreds of cases, even when designed properly, right? And we're talking about these situations. And so to know factually, beyond the shadow of a doubt, that not only could it happen, but it has happened, it is happening every single day, that people are getting hurt, that their policies are lapsing, that they're all happening. And then have somebody like Roccy out there being like, I'm not worried about that. This is what I believe. This is where I think it's going. So you shouldn't worry about it either. To me, super dangerous. Denzel, thanks for being here, brother. Matt, thank you. Everybody, thanks for being here. Till next video, have a blessed, inspirational day. Go do something cool. Go change somebody's life. We'll talk soon.